Good morning, traders. Today is January 7th, 2023. What an incredible week we had, especially the big turnaround on Friday. Markets up almost 3% overall on Friday as jobs numbers came out, and it's really sending some shockwaves through the market. But it is aligning very well with my wave 4 bottom, which hypothetically is right down here, and the potential for a wave 5 rally. Let me go ahead and start with this chart on a weekly basis, show you what's going on, and waiting for the data here. So from a longer term perspective, we've seen a very broad rally to the upside. So let me try to get back here to 2009 roughly and show you the very big base and bottom that's setting up. So here's the base in 2009. We've had this broad extended upward expansion, which I'm calling wave 3 to the upside. You can see how I've kind of drawn it as a wave A, B, and then really we have a C, D, E up to here, which is a wave 3 expansion. I'm calling this a wave 4 correction. I believe that wave 4 has ended and that we're now going to start a wave 5 to the upside. And these are the lines that I've drawn a couple weeks back, and they're highlighting what could happen. So I need you to be aware of what could happen going forward. I believe we're ending a wave 4 pullback, starting a wave 5 correction. If my analysis is correct, we will likely move forward, upward from here, up to this 55, let's call it 5,400 to 6,200, 6,300 upside target range right over here. If we see an extended correction period, we could see an A, B, C correction down to this level, which would be the end of a bottom wave, which would be the end of wave 4, and then start the rally back up to this level. And this, again, gives us the forward guidance to know that we are in an early stage reflation. We could see this move quite a bit higher. We could see it continue to expand upward, or we could see it roll over and move into a deeper decline, which would put us back here to these mid-COVID levels. I don't believe we're going to come down to these extreme lows, although we could. This was my original analysis, this 2015-16 area, providing very deep support. I believe these mid-COVID levels will do the trick for the markets. And I believe this is going to be an efficient downward deflationary cycle. But I need you to understand what's actually taking place in the market right now is US dollar strength and dominance, world crisis. So think of it as excluding the US right now is going through a debt and currency a revaluation phase, which is pushing fear into the precious metals markets. And it's a kind of a deleveraging event. As long as there's no catalyst for a U.S. crisis, which means we have to avoid a real estate meltdown, or if we have some sort of a deflationary real estate cycle, it's got to be moderate and extended. We need the U.S. consumer to stay strong. We need the U.S. economy to stay strong. We could see moderate contraction. So ideally, what would happen is moderate contraction, a slight deflationary cycle, maybe over the next 6, 8, 12 months, and then some sort of a reflationary cycle if the Fed begins to pivot and we start to see some upward movement. What I believe is happening right now is global assets are piling into U.S. equities and U.S. dollar-based assets, trying to avoid deflationary risk. And that's why the markets are poised to try to move to the upside, in my opinion. It would take essentially a shift, U.S. dollar shift, U.S. assets shift, some sort of a reflation or a decreased risk factor in the global markets to actually, excuse me, pull the appreciation value of the U.S. dollar-based assets into lower territory. Now understand that a reflation of global assets would likely be a reflation of U.S. based assets as well. So if we move into kind of a reflationary period, a reversion trade, then we're likely moving back up into this 44 to 4800 area. If we see some sort of a broad crisis event unfold, we could see this shift downward and really try to target this 2900, 3100 area on the ES or the S&P. And that's where we have to be cautious. Right now, we're setting up in a wave 4 bottom. We're likely to move forward, but we have this risk factor in here. Let me come over here to the daily chart, and I'll spread it out a little bit. We'll see what it looks like first. All right, we can stick with this. So really, here is our waveform bottom, right here. Right there is our wave 4 bottom. What I believe is the wave 4 bottom right now. We have not moved above this downward cycle trend channel, this heavy blue line right over here. And we need to see the markets rally back above this level and start to move higher. This would be a very strong rotation to the upside. Now, we do have resistance back over here at 4,200. We have resistance back over here at 4,470 roughly. You can see these levels off of these previous support levels here and back down in this level. So we have to be cautious of the upside move. But really, if the markets reflate like I think, we're going to see kind of a march upward up above 43, 42, 4,300 on the S&P. And then potentially getting up to previous all-time highs again, or recent highs, before we start to see some sort of correction. Now, this is barring any big global crisis event. If we do see some sort of a crisis event, we could see it melt back downward. It would likely try to retest this support level, and we're not out of the woods yet as far as an upward trend, meaning that we need to see this really start to accumulate to the upside and start to really appreciate, which I would call this the reflation trade. The global markets have reduced literally 30% off of or more off of global assets. The NASDAQ is down, essentially NASDAQ stocks are down 40 to 60% or more. You're seeing a big deflationary cycle take place here. It's not as evident in the U.S. markets because the U.S. market and the U.S. dollar has been so strong. This is because as this money was moving away from risks in overseas markets and foreign currencies, it piled into the U.S. market, which is why we've seen the U.S. markets hold up quite well. Now we need to see how it plays out. Do we get more of this U.S. dollar dominance while the global assets continue to deflate and try to bottom? Or do we see some sort of a catalyst event, which is possibly going to send the markets into a downward move? Right now, I believe we're looking at a fairly strong upward potential. I would probably guess this is about a 60 or 70% likelihood that the markets, that the Fed and the global central banks have enough capacity to navigate this efficiently, and we will see a reflation trade, which would be a reversion back up into this area right here. That's what I believe. Barring any big catalyst, we're targeting the 4,400, 4,500 area on the S&P moving forward. Now, let's come over to the custom index and MENT rotational modeling system. The MENT rotational modeling system is still in a 25% bullish mode, 75% bearish mode. The weekly mode is 25% bearish, daily weekly is 25% bullish, daily is 75% bearish. That puts us in a net short, 50% bearish, 50% cash. The system has not rolled bullish yet on the S&P, so nothing has changed. We had a pretty good 2022. We lost 0.6% overall in 2022. We're very, very close to new all-time highs, and the market just needs to roll one way or the other, and we'll likely start moving back into all-time highs. If we get a transition into a bullish trend on the daily chart, we'll go back to 100% bullish allocation with a new rally phase. We'll have to see how this plays out, but right now we've been very effectively protected, and we're looking for the next 3 to 5 years to be very powerful. The allocation modeling has not changed. we are 20% stocks, 55% cash, 25% metals. Our metals position has done very, very well for us over the past couple of months. I remember back April, May, June of this year, metals were headed downward, and I kept telling everyone that this is a great opportunity. If you're a metals bug like me, you have to understand what's going on in the global markets. The Fed has acted in a predatory manner inadvertently. The U.S. Fed, after 2008, 2009, continued with quantitative easing and continued with zero interest rate policy to prompt a recovery after the global financial crisis 2008, 2009. This led to a gorging of corporate and government borrowing on US dollar-based assets over the past 15 years or so, 12, 15 years. This means that foreign nations, foreign corporations have piled into hundreds of millions, potentially hundreds of billions of dollars of cheap US dollar debt. And the reason for this is very simple. You can borrow US dollars at 1.5 or 2%, converted to your local currency, say foreign currency A, whatever it is, run your business with this cheap debt, try to make 15, 20, 30% on the profits of running your business, offset your costs, turn around and pay the cheap US dollar debt. Everything was grand. This was a great carry trade where everybody was borrowing US dollars very cheaply, trying to run this this business model. And as long as commodities stayed cheap and there was no disruptions, everything worked out perfectly. Then came COVID. COVID came, disrupted supply, disrupted manufacturing, and disrupted demand. The entire process then sent crude oil up to $120+ a barrel, sent lumber skyrocketing, sent raw materials skyrocketing. Now, and it also sent the US Fed rate much higher. So now you have this scenario where consumers contracted, global economy contracted. So now you have less consumer spending, less consumer engagement, higher cost of doing business, higher oil costs, higher raw material costs. And you also have this, now you have these cheap dollar debt instruments coming due. And that means that you're having global corporations and global governments having to repay debt that they no longer have the capital to supply. So understand that if you can borrow US dollars at 2%, make 20% on it as long as raw cost stays solid and low and consumers continue to buy, you have a net carry of about 15 to 18%. But imagine you drop 10, 15% of consumer purchases, maybe more. So now your net revenue drops. You still carry this debt. Your cost of doing business goes up because raw material costs, oil costs, shipping costs go up. So now your net, you're still borrowing at 2%, but now your net goes from positive 15, 18% to positive 3 or 4%, maybe. But now you've got to get out of this debt. This debt comes due and you've got to roll it over. You're looking at lower revenues, lower costs, lower sales, higher costs, lower sales revenue, and you still have this debt. So you've got to roll this debt over. You can no longer get borrow this money at 2%. Now it's going to cost you 7%. So you now go upside down. Your cost of doing business has increased. Your sales revenue has decreased. Your cost of borrowing has gone from 2% to 8% or more. What was net, call it 10 to 12, 15% net positive, now turns into a net negative of 6, 7, maybe 8%. And as long as it carries forward and you continue to see slower consumer demands, slower spending, higher raw cost materials and operating cost materials, and higher borrowing costs, you're left with two alternatives. Either A, roll the debt into higher costs and figure out how to, actually three alternatives. Roll the lower interest debt into higher interest debt and deal with the negative cost factors. Number two, pay off the debt. which you can't do because you've tied it all up into longer term projects and you don't have the capital to pay off billions of dollars in debt. Or number three, look at default and or restructuring of the debt. And that's what's actually taking place throughout the world right now. It's not happening so much in the US market because the US economy and consumer are staying strong, but it could happen if the US economy falters. So we could see a wave of defaults, kind of like we saw with China and other foreign nations. But my reality is I think we're going to reflate back out of this. And I think the feds and the global central banks are actually trying to orchestrate a type of a reflation trade here, as long as inflation numbers moderate and we get back into some moderate economic growth throughout the globe. So now the big news here is that silver has turned positive on a weekly basis. Gold will likely turn positive very soon, but silver has turned positive. This is a sign that fear is elevating. I mentioned over the past couple of weeks that we're in a 2003, 2004 setup for gold and silver. Understand that that means there's 5 to 6+ years of a price appreciation in silver, and gold setting up for an ultimate peak probably in 2030, 2031. Oil will probably continue to slide lower, possibly down into the $63 to $65 level. Bonds are basing above 100. TLT is at, I believe, around 105 right now. Consumer staples are still bullish. Dow Jones is bullish. S&P is weekly bullish, daily bearish. Yep, that's correct. Mid-cap is bullish. Transportation is bearish. We're not seeing transportation rebound yet. This would be an early sign that the economy is rebounding. But our allocation levels have not changed. We're staying very protected, and we're using the metals position as a hedge. And metals will continue to act as a hedge no matter what happens, in my opinion, going forward with the global markets, whether we have a crisis event or not, whether we have the reflation trade or not. I'm expecting a 50 to 60% increase in metals prices throughout the next 12 to 16 months. That'll put gold up at around 23, 24, maybe 2,500, and that'll put silver likely up in the $31, $32, possibly $35 area. And then, like I said, we still have another 5+ years before gold and silver are likely going to reach some sort of a blow-off peak. Now let's go. Okay, so we're on to the charting. So now let's go over here. We're going to take a look at the accumulation phase index. We're starting to see, this is a monthly chart. We're starting to see a little bit of accumulation over here in early January. We've seen this type of a basing bottoming formation. If we can stay above this support level, this blue line here, we'll likely see this reflation trade. We get below this blue line level here, we're going to come down and potentially reach this mid-COVID level, which would put us right down in this area. What we're looking for right now with the accumulation phase index is we're looking for it to weaken back down into this lower green area here. This is what we need to see. So we need to see this RSI roll downward, stochastics roll downward. That would prompt a reflation trade here, and this would prompt this move here, and this custom accumulation phase index would mean we see this move downward into this kind of a green line area right back over here. So that's what we're looking for over the next couple of months, a moderate reflation trade. And there's going to be a ton of money moving into the U.S. markets now that we're into early 2023. There's been billions, hundreds of billions have pulled away from the markets over the past 12 months. And that's going to be looking for some opportunity. If the markets find a footing and start to reflate, you could see a fairly strong rally over the next 12 to 24 months. Next, the custom cash flow index weekly chart. You can see how the cash flow index has reflated here. We're right now dancing around this resistance level, which is the COVID high level. We need to see this really break out. It's really attempting to move higher here. We need to see what happens. Now, a Fed pivot would look like essentially, maybe a 0.25% a rate increase, or the Fed indicating that they're seeing some deflationary trends in the market. There was good news in the jobs report last Friday. that wage growth had softened. That's something that we're looking for, is moving back towards more normalcy. As long as the U.S. economy stays strong, we'll likely see some reflation trade. We could see this move up in the 160, 170 area here as this reflation trade continues. We obviously don't want to see it roll back lower. So that's why we're safely protected right now. We're avoiding risk, waiting for confirmation of an upward trend breakout. Consumer engagement index really bottomed and based, just like I talked about. This is a monthly chart. We had gotten down in these lows back in June of 2022. These are really 2012-13 low levels. This is a very deep consumer pullback. Biggest decline we've seen, even bigger than 2008, 2009 global financial crisis. It looks like we're bottoming in this area, guys, and consumers are starting to come back. If we get a good consumer rebound here, this is going to skyrocket very quickly, 20, 25% back up into these areas and try to break this channel. So be aware, if consumers rebound in early 2023, this could really create a big, broad upward price pressure in the U.S. stock market and the economy overall. The custom devaluation cycle index is down near these lows. It's going to start to rebound back to the upside. This is extreme devaluation. You can see that we're down here near these extreme low levels. This is the middle channel on a broad standard deviation channel. We're down here near these lows. We need to just see this kind of confirm and start to move to the upside, which is what we're waiting for right now. The large cap index has stalled out. Still not seeing any growth in the large cap index. This is very deep depression. End of 2022 reached new lows. We're looking for this to base and bottom. You can see historically these types of pullbacks. This is basically a 15 to 20% pullback, are fairly common, but then we see some sort of a basing. I wouldn't be surprised to see this really reflate back up 15, 20% in large caps if we get the wave 5 rally attempt like I'm looking for. Again, we have to be cautious of breakdowns. As long as the dollar stays strong and the capital flow stays very positive towards US dollar-based assets, we will likely see a reflation back to the upside. The global asset index looks very similar to the large cap index, basing and bottoming over here. Very deep lows. You can see this is a fairly broad consolidation. It's actually started back over here in end of 2020. So we've seen this big deep pullback here. We need to see if this holds up. If we get some sort of a breakdown here, things could get ugly very quickly, and I'll keep you aware of that. But that will likely push metals, if we do get a breakdown, likely push metals 5, maybe 10% lower from where they're at, but they will rebound very quickly on fear, and then they'll start to push higher. Metals will. So we need to see how this plays out. Right now, without a catalyst, like I said, I don't see any real risk to the downside yet. Custom gold cycle index chart. This is early January. We are seeing still moderate accumulation. This is all accumulation in this area. Off of this bottom here, when it started to move upward, this is accumulation. We had a little bit of move. This is a monthly chart. A little bit of move of accumulation in December. We're now seeing moderate accumulation in early January. I'd like to see this move a little bit higher. We'll see how it plays out, but this is good, solid accumulation in metals. People, you need to understand that metals enter these accumulation phases, could stay this way for 2 years or so, which would prompt a moderate appreciation in price. So this is really where it gets to be an excessive kind of a speculative phase before a blow off. Okay, you see here 2011, this was our big blow off rally. Then we had this kind of accumulation phase here, and then we started to deflate after 2000, and this was the peak here. Then we had this deflation, then we had accumulation, speculative, and then deflation, base bottom accumulation, more deflation, base bottom accumulation, kind of a peaking value. This was the peak in post-COVID, the 2020, I believe it was, high. Now we've had the deflation, and now we're getting into more accumulation here. Next, we have the innovation index. The innovation index is basing and bottoming. I still believe technology is a great opportunity, with the caveat that you start with small token positions. I believe technology has unwound an excessive amount, and we could see a very strong reflation trade in technology, but I do not advise going all in on technology right now. Small token positions, or what I call anchor positions in technology, would be fairly safe right now. Tesla, Microsoft, Disney, things like that. This is probably a great idea to go pick up a small, maybe 0.5% or 1% of your total portfolio as a token position in preparation for what may come later. But we've seen a very strong devaluation. I believe this is very close to a base and bottom. We'll just have to see if my wave 5 rally phase takes off. The custom fear index has dropped back down to 6.85. That's great news. That means that we've moved away from the first level of fear. We are still in an uptrend here on the SPY, and the market sentiment index is moving positive. This is a weekly chart. So we need to see this really start to move back to the upside for a reflation trade. That will cause the SPY to move higher, possibly up into this 425, 430 area, and that will push the fear index downward, which is ideally what the reflation trade will look like. Next, we have the real estate cycles index. We've moved to new highs. The way I would explain this to you, ladies and gentlemen, is that this is the most hostile real estate environment the U.S. has seen in 20 plus years. I mean, these are the 2008 peak before the market turned ugly. This is the bottom, the base. We then stayed within normal channel cycles up here until 2015-16, rolled back down here near lows in 2018, came back up here to a peak in 2019, then became very opportunistic post-COVID. This was the zero interest rates. Prices were skyrocketing. I mean, this was the best opportunity for a price decline or a price advance in the markets right now. Now you're looking at a very hostile environment where price declines are extremely likely. Risks in the real estate market are extremely high. We'll see how it plays out. This is the most hostile environment that I've seen in real estate in 20 years. I'm surprised right now that we're not seeing greater price declines, but I think it's coming. I think it's just a matter of weeding out the transition over the next 10, 12 months. I wouldn't be surprised if by March or April we start seeing broader price declines. This is an average of the home price index. You can see we're extremely high. We're up above the standard deviation, 2x standard deviation channels. My opinion is we're going to come back down into this 290 to 310 area, which would represent a 20% decline from where we're at right now. So when you start talking about, $1 million homes, you're now talking about $600,000, $700,000 homes is a real value, possibly 12 months out into the future. For a $500,000 home, that's going to be looking more like 370, 360, maybe in that area. Next, we have the tech ratio index showing very good signs of a roll here. RSI is hooking upward. Stochastics has completely bottomed out. We could see a nice moderate reflation trade back up into this 4-5 area right over here. This is, again, about a 20 to 30% reflation trade, looking very solid off of this deep, deep decline. And you can see, again, this is really from 0.67, let's call it, down to 0.29, 0.28 down here. This is really a 65% decline in technology, if not more. A moderate reflation back up into this area would put it back into 2016-17 levels. And maybe a little higher, and that would reflect about 30 to 35% reflation trade in technology. Could be very opportunistic. And again, pay attention. I'm warning you right now, we could see a very big reflation trade if the wheels don't fall off the train and if we don't see some big catalyst event. Okay, this is the most important chart so far. okay, is that the U.S. markets are stalling, trying to find a base, trying to find a bottom, have not rallied above this pink trend line yet. The global markets have started to move higher. They've actually broken this downward trend channel, which means global markets are starting to appreciate upward. We need to see this continue. We need to see this to get back up into this area. This would mean that the U.S. market would start to move up into this area and start to reflate again. So we've got this kind of a scouting party pattern right here. It's looking to see if it can break to the upside and begin a reflation trade. This means that global markets may start to reflate before U.S. markets, but the U.S. markets will reflate as well if it happens. So now we need to look at where we think this is going to go. I think it's going to go likely back up into these pre-COVID, this 2019 area, which from 16 to roughly 30, this would be about a 20-25% rally. The same thing here would be about a 25 to 30% rally from where we're at here at 54 up into this 71-72% area. So pay attention. This is the first sign that we're getting some real reflation here. There's another couple charts that I'm going to show you that show the reflation is taking place as well. The custom valuation trend index has been basing and bottoming. This is really the blowout low. This is kind of a capitulation low at the end of 2022. Now I think we're going to reflate back up into this 2.1 area where I'm pointing, this 1.0 area here, 2.15, and that again would be about a 15, maybe 18% reflation trade. Ideally, we could even get a little higher. We could get back into this 2019 peak area right over here before COVID. And I think that we're going to likely see this happen as a measured move over possibly, 10, 12, 15 months to reach possibly new all-time highs by the end of 2023 or in early 2024. From there, we could see kind of a new reflation cycle up to 4,700 to 5,300 on the SPY or the ES, but we need to see some real basing and bottoming first, okay? We're not there yet. We're starting to get this, and you can see this type of a downward decline has happened repetitively. We get this pullback, 15, 20%, 25%, then we reflate to new highs. Then we get a pullback, then we reflate to new highs. This is about the same range of pullback. We may reflate to new all-time highs again. The custom leading index really starting to reflate here. We've got a rollover here, which means we could see as earnings start to play out in early 2023 for Q4 2022, we could see this roll around a little bit. I do expect to see some downward revisions of earnings, but I expect overall it to be fairly healthy Q4. I think towards the end of January, we could see this reflate back up into this 2.2 area, maybe 2.25, 2.3. And I think we're going to see a fairly strong rebound out of this as long as there's no massive downside catalyst. Okay, here is the volume ratio chart. We did see a new range of accumulation taking place in volume. This was to be expected. Remember, I warned that this would happen in early 2023. We may see some big spikes here, guys. We may see something like this, kind of a big spike after the COVID bottom, spike, spike, spike. This is just after COVID. This was accumulation, buying the dip, and then we started to rally back out of this. So if we start to see some big spikes up above 10 here, then this is really a good sign that traders are starting to accumulate, moving into a very optimistic early 2023. This 5.39 is a fairly solid number. We need to see something really above this 7.5 or 10 to see real strong accumulation. And I'll bet we probably get it in January. We may get one or two of these spikes. The commodity to gold index is flattening out. This is actually quite positive. We need to see the commodity pressure, price pressure subside. That will help the Fed move into a more dovish mode, helping the markets move into a reflation cycle. Right now, not seeing any massive change here in range. You can see how tight these bars have gotten. You can see how wild they were back over here, how tight it got right down over here. I'm very happy to see this flatten out and stay in this range, maybe decrease a little bit over the next 6 months or so. This is very deflationary. This is exactly what the Fed wants in terms of seeing pricing pressures subside, seeing everything kind of revert back to a normal. Think of this as, a pond, a water level in a pond. When you start having all of these massive range levels, these are like a rock has been tossed in the pond. Now we have big waves rolling all over the place. This was the post-COVID inflationary cycle. This was the deflationary cycle taking place. This was when the Fed started raising interest rates, and where we had to see this is the spike in global inflation that disrupted the markets, that put all of the credit, debt, and global economy pricing pressure into place. Now this is unwinding slowly. So if we take a look at a longer term average, you'd probably be up in this area somewhere, moving downward. Over the next 12, 18 months, this is going to probably move quite a bit downward, down into more normalized pricing structure, and that's going to give the Fed the ability to start softening a bit and moving into more dovish territory. It's going to still take 6 to 12 months, but it's going to move the markets into a reflationary cycle, in my opinion. Okay, custom metals trend index. This is very positive for gold and silver. We are back up here near resistance. We need to be very aware of the potential for some sort of a pullback here. We've seen gold and silver really appreciate, but we have not seen a decent pullback. We could get a breakout. We could get a real big rally here before we get some sort of a breakout or pullback in gold and silver. But I need you to be aware that we have really seen very strong trending, very strong accumulation. I would not be surprised to see gold and silver pull back 5, 6, 7% off of some sort of a move and really base around this red line right over here before attempting to move substantially higher. But again, at the same point in time, traders are moderately fearful. I could see this really break out to new highs, and if that's the case, gold and silver will continue to trend higher and potentially start moving. Gold possibly back up to 1950, 1970, silver possibly up into 27, 28. Silver's been just on a terror lately. Long and short of it, folks, this could be a very big, broad move in metals. Don't let everyone fool you. You can see this upward cycle trend is really starting to build some momentum right now. It's just the price of metals haven't really followed through, just like this custom trend index, but they will. As long as this upward trend continues in the custom trend index, the price of gold and silver and platinum will continue to appreciate. FANG's index, really interesting, getting all of these little black bars. Let me explain to you what's going on here. Normally in an uptrend, we get up bars, and a downtrend, we get black bars. That's the basic premise of Japanese candlesticks. What we're seeing here, ladies and gentlemen, is downward pricing pressure in an accumulation phase. And when this breaks to the upside, when it starts to reflate, it's going to skyrocket. It's going to really begin to move upward. You can see we've seen this upward pressure here. We could see this happen right after the Q4 earnings data. We could see it happen very quickly, which is why I'm telling you, I think technology is a really solid anchor position for skilled traders right now. A reflation trade would move this from roughly 279 up into this 350, 370 level. That would essentially, if I do my math right, that would be about a 25 to 35% reflation. And that would put us right up into these levels over here. This is a very solid, in my opinion, accumulation phase that's taking place. You can see that we're not establishing new lows. We've got this new high right over here. Briefly, this tells us that we're likely to move back to the upside. What we need to see is a reversal of trend, and we need to see it break above this 310 level, 315 level, this red line here. And then we are seeing a very strong reflation in technology. But really, look at historically. So 2019 bottom, this was the end of 2018, excuse me. We saw this low back here and reflated. COVID low and then reflated to highs. Post-COVID bottom, back down to these levels and then reflated back up here. I believe that technology has been basing and bottoming for the past 2 or 3 months. Really, it's been in a kind of a let's call it a stealth accumulation mode, and it's just really ready to reflate. There is downside risk. I warn you right now, something were to happen, catalyst event, could see a big breakdown, could see it come back down into these lows here near this blue line. But I think we're seeing this as accumulation. I think smart traders have been accumulating down near these lows, preparing for a reflation trade and a softening Fed. The base metals, this is the metals index. And you can see last week we had a huge rally in the custom metals index. This is following that custom metals trend index higher. I believe we're going to move back up into what I call the yellow brick road here. We're going to see this reflate, rally back up into this 480, 490 area, and then start to really reflate back to the upside area here. This was, as I warned, all through this area, deep basing and bottoming. This was an excellent opportunity to buy into as much as you could, and now we're seeing the real reflation trade. Once we get up into this, what I call the yellow brick road, which is between these two gold yellowish kind of lines, then we're going to see some real appreciation. And I mean, the next 3 to 5 years in gold and silver could be incredible. And when I say incredible, give you an idea, think about $65 to $75 silver, and think of $4,800 to $7,500 gold. We're talking 300 to 500% move from where we're at right now over the next 5 to 7 years, and it's just getting started, ladies and gentlemen. Okay, smart cash index, which is very similar to that US to global market index. You can see we've rallied above this level. We still have resistance here at this blue box. We need to see it move higher. We're at an early stage scouting party. We could see this just stall back out over the next couple of weeks through earnings. So don't get overly excited about this yet. If we can get above this blue box area, and particularly this high back over here, then we could see a reflation trade back up into this area here. But we're seeing the global market start to reflate before the US markets. This is a very good sign, but we do not have any technical confirmation with the MENT rotational modeling system or other signals yet that we're getting into a big, strong reflation trade. Now, earnings, Fed data, jobs data, continued downward deflationary cycle pressure could help move the Fed into a dovish stance, which could move us into a broader reflationary trade. But again, the risks are still fairly high. I would say that we've got a 60% chance of a reflationary trade cycle right now, and about a 40% chance that we could stall out and potentially roll lower over the next 3 months or so. That means that the risks are still very high. So this is not the time to, like I said, to start betting the farm and leveraging yourself into trades. This is the time to stay cautious, wait for the markets to tell us what's going on. If I'm right and we're going to reflate back up, we're going to see a 3 to 5 year upward cycle where we're going to be able to ride it out. If I'm wrong and we roll over, we'll know soon enough and we're safely protected. Okay, we've gone through that and that. The US stock market index is flagging out. You can see this standard deviation channel here. You can see we've broken this channel, this what I call Fibonacci price amplitude arc. We're starting to break out and try to break out of this upward cycle here. We're holding up above this downward channel, this upward sloping standard deviation channel. We could see through earnings another brief roll lower here in the US markets, which would be what's called a false breakout. And then we could roll back to the upside. I'm thinking really more like January 25th through March 15th. I think we're going to see a real reflationary cycle trade. I think we're going to be preparing for Q1 earnings, which could be very strong, especially if the U.S. consumer continues to spend. I mean, U.S. consumer, if you go out and look, people are still out shopping, still out spending, and really, the U.S. economy is the strongest economy on the planet right now. Custom valuations index chart starting to move a little higher. This is good to see. We might start to melt upward over the next year. It would be great if this melted up to like 73, 74, 75. Slow and steady melting upward would mean that the reflation trade is accumulating and building momentum in regards to valuations. We've seen this deep, deep low. This is actually good confirmation for a reflation trade in early 2023. We do need to see it continue to move higher. We do not want to see it break below, say, at this point, call it 50. We do not want to see this break below this recent low over here. We want to see this continue to melt upward. So hypothetically 60, 61, 62, all the way up maybe to 70, 72, 73. If we get above this 80 level again, then we're getting into speculative mode. And that will happen in potentially 2026, 27, maybe 2025. But we want to be cautious of the speculative mode. If we get into a speculative mode, then we have to trade very cautiously and be prepared for the next big deflationary cycle mode, well, which would be likely 2027, 28, 29, and 30. And that could be a very big downward cycle phase. And lastly, the volatility index chart. You know this is my favorite. Look at this beautiful consolidation up near this channel. If we get Q4 earnings staying fairly positive, earnings outlook staying fairly positive, and the economy continues to click right along in the U.S., I would not be surprised to see this move into the 11, 12, 13, 14 range into February and March, through the end of January, February, March, moving back into solid bullish territory. This could move us into a new upward channel. I'm not drawing it yet, but you can see this channel back up here. We got below it. I would likely try to draw a channel across the COVID range here, trying to move an upward cycle channel forward, and really pay attention to what's taking place here. Overall, the basing and bottoming formation that took place, so we had this big COVID low. We see it rally up to this high. This is 1, 2 down to here, 3 up to here, 4 down to here, and we're looking at a 5 breakout reflation rally. This would start us into a new uptrend that could last into 2025, 26, 27, 28, maybe. And it would be a very solid 4 or 5 year rally cycle. There will be some pullbacks. Don't take it the wrong way. It's not going to be the same as the big COVID rally. It's not going to be that aggressive. Could be somewhat aggressive in 26, 27, 28 as a speculative peak might take place. But we're looking at a very early stage. Like I said, I kind of think if I come back here and go to monthly, I kind of think we're in this 2003 rally phase. So if you were to tell me, Brad, give me your best bet, I would tell you that we are right here, right in this phase right now. Come here. Trying to draw and get my mouse to cooperate. I would tell you that we are in this phase right now. We have reached our low. We've come back off of the low. We've come down and reestablished a lower low. That's the low that happened back in August, September of last year. Now we're in this early reflation trade. The first phase of the reflation trade is going to be a move up above these recent highs back here, stalling out. This is where we start to see accumulation, which we're starting to see some accumulation take place. Look back over, whoops, wrong one. This is early stage accumulation. This is early stage accumulation. People are buying into the bottom. This is early global market accumulation. People are starting to buy into the bottom. Metals are very fearful. And let me try to add a symbol. Insert symbol. And we'll just add gold. See if we have it going back. Okay. And let's see how far back this goes. Perfect. Well, almost. So here you can see gold back over here on a monthly basis starting to really accumulate. And then look at what happened during this cycle phase. Yes, gold moved downward during this big decline, but from where we're at right now, so let's take a look here, hypothetically from these lows to this high, we had a where did it go? There it is. Wait for my server to respond. 130% rally in gold. Okay, if my analysis is correct, that we are in this phase right now, and gold is trading at 18, call it 1850. If we were to see this same reflation trade take place over the next 3 to 5 years, that puts gold at around 42 to 4400. Then we would see gold collapse from, say, 4200 down to, say, 3700. Then we move into, and this would maybe be around 2025, 26. Then we would see gold really begin to rally. And from that low, we would see gold rally from here to here. And look at the size of this rally. And when you consider the total scope of what's actually, so there's another 179%. So if we go from, say, 4,400 to 3,700 and then go up almost 200%, that'll put us at $7,500 gold, maybe even higher. But now take a look at this from a standpoint of where the markets actually went. So gold went over this entire timeline up 349%. So you take the math, call it $1,800 gold times 3.5. If I do the math right, that's going to put us at around 72 to 800 to 8,500 gold. And look at what happened with the markets over this time frame. We had a from this base level up to this level, we had approximately let me move this up. We had approximately about 100% reflationary rally, 83% reflation trade in the stock market, followed then by a moderate collapse where gold only moved down about 20-25%. Then we had, and I'll just move this, I'll duplicate this and try to drag it. Then we had a big, huge reflationary trade that took place. And again, this is the post-COVID, post-global financial crisis recovery. And this was a massive 500% rally, if I remember right. I mean, it is just incredible. Yep, 514% rally. So imagine that we're sitting right now, right over here. We're sitting right here. It's the exact same setup, in my opinion, ladies and gentlemen. We've got the early stage basing. We're going to see this reflation trade, possibly to new highs, then possibly some moderate rollover, maybe not as deep as this. Then we'll continue higher through an expansion phase without having this big COVID blow off, which will see potentially another 200 to 300% rally phase into 2027, 28, 29, 30. Then we'll get the rollover event, which will be somewhat like this. It'll be more of a global devaluation event. And in reality, ladies and gentlemen, that's what I'm trying to draw. This is the same setup. Whoops. Whoa. So here you go. I know it's almost best to go right to the end of my charts, huh? That's fine. So here's the setup, and this is the 2027, 28, 29. This is the rollover event. that I'm talking about likely to take place in 2030, 29, 30, 31. And this is the real reflationary cycle trade. Now, my targets are very conservative. If we were to get a very big speculative bubble out of this, we could see something really roll up into this 8,000-9,000 area and then come down. And that's something which would be what would be an excess bubble. It would really be scary. It would be super exciting in the long run to think that, oh my gosh, we could have this massive, come here. My server must be acting very slow. Okay, whatever. I'll leave it. So this could be the big excess phase bubble peak right now, setting up. I think we're going to move into this 6,500, 6,800 area and then stall out in base and bottom. And this is what I think is actually going to take place, is this broader reflation trade coming up into this area first, stalling out, then up into this area, then possibly rolling over into an extended excess phase peaking pattern, and then breakdown in 2029, 2030. And then during the breakdown phase, this level becomes again very critical. This pre-COVID level becomes very big support for the markets, and we're looking at this being the real critical support zone. So what would that be as far as a downturn? Hypothetically, if this were to happen, we'd be looking at a, come on server, there we go. We'd be looking at, again, a 58% downturn. Oddly enough, that's exactly the same type of collapse that happened in 2008, 2009. So that would then set up another recovery phase here for new highs. So there you go, looking very far out into the future. You know, do not, I'm going to warn you, do not listen to the doomsayers. Yes, there's a chance we could see a downward move. Yes, there's a chance that we could see something, some kind of a crisis event take place, or global war, or financial crisis. But nobody is planning for that to happen right now. Nobody wants that to happen. The general human psyche is to continue to reflate the market. And that's where I think we're transitioning right now. And I think the odds are, like I said, 65, 70% that we're going to move into a reflation cycle right now in 2023 and 2024, possibly seeing some rotation in 2024, 25, and then reflating even higher in 2026, 27, 28, 29, maybe reaching a peak in this area. And then we really start to need to be concerned right in this area. So I hope you guys are enjoying my research. Big changes are coming. Share my research with everyone else. Let them know what I'm doing and be prepared. Right now, the markets look very solid. We just need to kind of get through the next 15, 20 days, gauge what's actually happening, and then we'll have a better understanding of what's going to take place over the next 6 months. All right, guys, talk to you soon.